In this short video, I want to take on an issue that's crucial for investors if they want to invest in the stock market successfully, and that is to avoid single stock risk. We don't recommend that you pile all your money into individual stocks, even if those stocks appear at first glance to be rock solid and safe. Diversification is crucial, and time in the market, rather than trying to time the market, is a useful ally of that basic principle. So with no more ado, why do we not like single stocks? Well, all stocks can be volatile in the short term. All right? Any sector is potentially vulnerable to a dip, and any stock within a sector is potentially vulnerable too. So I want to make this point by just taking three stocks: BP, once the biggest company in the UK market; Tesco, our biggest retailer; and G4S, at one time the world's biggest security outfit. And what I want to do is just demonstrate that even though those big branded names look like solid bets, they can all make mistakes, they can all suffer. And these three companies all made individual mistakes. Now we'll look at how to correct that as an investor in just a moment. But first of all, I'm going to keep the facts fairly brief. Most people will probably remember or know about BP's massive oil spill that hit the headlines. Even President Obama commented on it at the time. So what I'm interested in is the effect on the share price, and it was pretty dramatic. You're talking about the biggest company in the Footsie 100 index at the time, and look what happened, bang. There it is, a huge fall in the share price. That was around a 50% fall in the share price. That halved the value of BP. They slashed their dividend, they slashed investment plans, they faced fines and all the rest of it. And that's partly why the share price has never recovered. If you look at where it is now compared to where it used to be, it's never quite made it back. It's not quite climbed off the ropes, all right? So even the biggest company in the market is no automatic shelter for your investments, hence diversification. Let's take a second problematic stock, Tesco. All right, went on a fantastic run and then this happened. All right, there's the one I want to just highlight. They ran a campaign at the end of 2011 to attract shoppers. It was a £500 million worth of campaign, cutting costs, promoting certain products. Everyone thought that would push sales. It didn't push them far enough. Okay, effectively they issued a profit warning, analysts panicked, and the share prices bumped along ever since. G4S, most people remember the Summer Olympics last year, and most people remember the problem they had staffing the Olympics, and as a result the share price took a hit there at the time, and it's taken another big hit a bit more recently when a profit warning unnerved analysts already a bit twitchy about what happened back in 2012. Clearly quite a high profile mistake there. So you can see that my point here is that any company, no matter what size, no matter how well known, can make a mistake. No matter how profitable, can make a mistake. So as an investor, don't go chasing single stocks. Instead, you want to go after some sort of portfolio. Now, just as a quick comparison, we could look at the Footsie. I mean, the Footsie is a sort of portfolio. It's the 100 largest stocks in the UK market, and see what happened over the 5-year period from 2007 to 2012. And you'll see that during the period of those problems I just mentioned, the Footsie sort of wobbles its way up over that period. But why am I not going to suggest you just go, right, well, I won't do single stocks, I'll just do Footsie tracking instead? Well, the Footsie isn't perfect. The problem with the Footsie 100 is it's size driven. The biggest companies float to the top of the heap. So when a BP happens, it feels the pain too. It's around then, okay? And as a result of it basically promoting the biggest companies in the market by market capitalization, it tends to be quite sector concentrated. Like the Footsie 100 is often dominated by just a small handful of sectors, as little as 3 or 4. So, although you might think you're diversified in the Footsie 100, actually you're less diversified than you might think. So a better bet is a properly diversified portfolio. You'd be glad to know you don't need anything like 100 stocks in it. I mean, 100 stocks would incur all sorts of trading costs and charges, and actually it's unnecessary in the context of achieving diversification. Now, do a little bit of science here, but not too much. I mean, how many stocks is a sensible number if you want a diversified portfolio that's not driven purely by the size of the companies in it? It doesn't have that market capitalization bias. Well, this chart just shows the percentage of sort of single stock risk remaining as you increase, that's this axis here, the number of stocks in the portfolio right the way out to sort of 49. And the reason I've stopped at 49, I could have stopped much earlier, is that while single stock risk plummets, I mean, just by holding a couple of stocks, you can take away the single stock risk. That's the sort of catastrophe risk of one bombing. You can remove some of that, reduce it by around 40 to 50%. Once you get out to sort of 15, maybe up to 20 stocks, you have effectively taken out most of the single stock risk. You've achieved diversification, and adding stocks is, piling up the costs, potentially, and the hassle of administering the portfolio, potentially with only a marginal gain in terms of the risk that you're removing. Now, talking about single stock risk here, that's stock-specific risk. If the market crashes, this principle of diversification won't protect you from that, but there's one or two things we can do about that in just a moment too. Okay, so what am I suggesting? All right, what I'm suggesting, and this is purely an illustration, is that you want a properly diversified portfolio. Now, here's an example, of just an illustration, all right, of a theoretical diversified portfolio. We've got a period of 4 years, up to December 2013, all right? We're showing the holdings down the side, and bear in mind, I'm not tipping these stocks, so this is not a model portfolio, okay? Just because a company made profits in the past doesn't mean it's guaranteed to make profits in the future, doesn't mean it's guaranteed to make profits at all, okay? But what I'm suggesting is that you could construct a diversified portfolio of 15 stocks down the side here. All right, what I've done is to evenly weight. Now I've put £5,000 into each one, so there's 5,000 there, 5,000 there, and 5,000 there, and so on. So we're not market capitalisation weighted, we're not market weighted now, we are evenly weighted, and in fairness, putting exactly £5,000 into each stock can be difficult in practice, but bear with me, it's just an illustration. I've ignored costs and so on, which obviously you'd need to factor in to set this portfolio up. The point is this, we haven't gone out and chosen the absolute best performers in the market. There are some strong performers at the top, there are some sort of medium performers, and then some weak performers at the bottom. But we have tried to just pick a sort of spread for illustration. We've got G4S, we've got BP, and we've got Tesco. And we've included the periods where they all hit trouble. Okay, that period from the end of 2009 includes the BP problem, the Tesco profit warning, and the G4S Olympic fiasco. And the point is basically this. Right down the bottom here, it says total, 75,000 in the end of 2009, worth 104,836. All right, no need to be too precise about it because it's, I'm not saying this is something you definitely want to go out and do with exactly these stocks, but that's a gain of around 40%. Against the Footsie's, let's say 25, there's your Footsie 100 right at the bottom there, okay, as a comparison. So my point being that a properly diversified portfolio, okay, can achieve the sorts of returns with the sort of security that you want, as opposed to sort of taking the sort of single stock risk I was talking about, of just simply trying to track a benchmark like the Footsie 100. All right. And another point here is that we've got a very wide range of sectors represented. I'm not saying you pick exactly these stocks, but something like a dozen sectors represented there. That's a broader representation potentially than you get from a market-weighted index like the Footsie 100. Okay, so there it is. So let's sum up here. Diversification is designed to reduce single stock risk. All right, single stock risk is the risk that any stock can hit a bad patch. It won't eliminate market risk. All right, if the whole stock market crashes, it could take an entire portfolio down with it. However, as an investor, you can mitigate that by never panic selling and never force selling. Plan your future cash flows. Don't be a person that thinks, oh, I've got to liquidate my portfolio now. You don't want to be in that position. If you plan your future cash flows properly, you shouldn't be. Set aside your rainy day fund, forecast those points in time you need to pay for a wedding or pay off an interest-only mortgage, and so on. All right. So, worth remembering, just to wrap up, something I mentioned right at the start of this video. Once you've got a fully diversified portfolio, don't tinker with it too much. Time in the market is crucial to let that portfolio grow and develop over more than the 4 years that I showed you just now, rather than trying to be clever and timing the market.